If you're looking to buy Mullen Automotive stock, then keep watching this video because we're going to look at the company's recent news, how the market's treating the company, what are the technicals telling us, and most importantly, what is the best trading approach. As the market is very volatile at the moment, we should be mindful of which positions we take on, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Mullen has created a sensation in the stock earlier this year, and its share price increased by more than double after a period of sharp decline. The reason why so many people were attracted to the company has been twofold. On one hand, the company has been showing great potentials with battery technologies along with positive test results. On the other hand, Mullen has also been trading at a very low level to begin with, limiting significantly shareholders' downside risks. Just picture the following. If Tesla were currently priced above $1,500, would you be willing to invest in the stock without any hesitation? Or would you prefer to stand on the side and wait for some retracements before going in? Well, it is exactly this kind of situation with Mullen, but the other way around. People know that a company has been priced at much higher levels at some point in the past. People see that the stock has been sold off significantly, and people can also tell that the stock might have been oversold. This is why the share price of Mullen has been able to take off a few months ago, and I believe that we're now looking at a scenario where the stock could take us to new levels once it is able to maintain the stock price above $1. Now, let's take a look at the technicals of Mullen. The trading volume of Mullen Automotive has recently been 65 million shares, compared to the average volume of 46 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.90. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is very thin, it's very easy to influence the stock price, but with very low liquidity, it could also mean that getting out of it is very complicated. As we compare the current volume against the average volume, there might be a possibility for trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Mullen Automotive is currently around $359 million versus the enterprise value of $112 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's own reputations, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be intangible, meaning they're not items that could be used right now, but pledges for a brighter future, such as intellectual properties, brandings, and schematics. For startups, most of their valuations are based on the intangibles, which could be valued in more favorable market terms. What this means is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below the book value, but it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and only deflating back to somewhere normal. As we compare the current price to the historical price fluctuations, the stock is 16% higher than the 1-month low, 16% higher than the 3-month low, and 70% higher than the 52-week low. On the options market, giving us a hint about the market sentiment of where the stock price could go next, the implied volatility is 157% versus a historical volatility of 111%. The put-call volume ratio is currently 0.31. It is normal for most stocks to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 26,000 contracts a day versus the 30-day average volume of 30,000. Regarding the open interest, The most recent volume of open interest has been 418,000 contracts versus the 30-day average of 468,000 contracts. The option contracts are tools allowing traders to hedge their risk, increase their exposure with limited downside, or to have an additional revenue stream. They are derivative contracts based on the underlying security. They give traders the possibility to buy or sell the security at a predetermined strike price and help limiting the potential downside. The put options allow selling at the strike price, usually chosen for anticipated downturns, and the call options would allow buying at a strike price, usually chosen for anticipated bullish runs. In terms of shareholder structure, institutional shareholders own 1.8% of the outstanding shares. The biggest shareholders include Vanguard, Citadel, and Susquehanna International. Usually, it is best to see some institutional participation when holding the stock long-term, because it offers a layer of stability and token of reliability in the medium to long term. This means that the market is confident that it'll deliver value in the long term, which is an important factor to consider for investors. I personally consider that a minimum threshold should be around 25 to 30% for institutional ownership, but there could be a lot of exceptions to this rule, since many great companies mostly owned by retail traders also exist. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, that could be a sign that there is an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 16% of the total float, and 55% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it is coming out of the dark pools, this could suggest that there are institutional positions taken to short the stock and that there would be potentials for a short squeeze. Given the current circumstances, I believe that the best thing to do is to buy a small position in Mullen because its price is very low, and to keep at least 60% of your allocation for later. I would prefer to wait until the stock price goes back to above $1 in a sustained manner before committing the remaining capital. I would recommend to commit between 3 to 5% of your portfolio, and also to split the allocation in batches of 20 to 30% at a time so that you could purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.